Yeah. Well, we are at the top of the hour here. We should probably get started. Welcome, everyone. I am excited to have you here for an overview of executive compensation planning and strategies. And we're very excited to welcome back our special guest, John Nersesian. John is the head of advisor education at PIMCO, one of the world's largest asset management firms. And he's in the teaching faculty at University of Chicago's Booth School of Business. And I know he's had a number of prominent industry roles in that vein in terms of training and certification with the Investments and Wealth Institute. And we recently had John on for a wealth strategy session where we talked about residency planning and the myriad of implications in terms of depending on which state you decide to call home. And that was fantastic. And, I'd say, John is highly credentialed and experienced. He's a really great presenter. I've worked in this area, this niche, executive compensation planning, my entire career. I've taught these topics myself as an adjunct faculty in the CFP program. But I'll say, every chance I get to see one of your presentations, John, I always jump on it, and happy to have the benefit from your consultation in this area. So we're really excited about this this session. So maybe a few quick overview housekeeping details. There's a Q&A area here in the Zoom call, so feel free to type in questions. We'll probably try and get to most of those at the end, but I'll see if I can work some of them in as they fit and they come up. And feel free to follow up with myself or any of the team at Cahill if you have any specific answers. And along those lines, to stay in good graces with our compliance department, we need to clarify that myself, Cahill Financial Advisors, we are not associates of, we're not affiliated or employed directly by PIMCO, and in turn, PIMCO is its own independent organization. And we're talking about general strategies, education here. Nothing that we're talking about should be considered, specific financial advice, tax advice, legal advice for anyone listening on the call. You need to seek your own professional guidance. They say, feel free to follow up and give us a call at the office. So that's kind of the disclosures we need to throw out there. But John, I'm really looking forward to this conversation. I find this to be a very interesting area. We do work with quite a few executives, and they have all the regular financial planning issues of funding various goals and tax planning and insurance, real estate, and cash flow, and of course developing a portfolio strategy. But then you have this very interesting extra layer of complexity that's very unique, where they might be receiving significant parts of their compensation in the form of something tied to the company stock, restricted stock, stock options, a few different flavors there, and maybe some tax advantage savings opportunities like employee stock purchase plans or non-qualified deferred compensation plans. And it's an interesting area. And I think when you're looking at the different implications here, analyzing the company stock, thinking through the tax analysis. And one of the things I'm really passionate about is not just taking those two areas, but tying that together with the individual client's specific goals. So it's not just looking at these external type factors, but, is retirement funded? Are we on track for children's education or your philanthropic goals, whatever those may be, and really making that part of the decision-making process as well. So,
great observation, Scott. I think that's often the tendency is the individual who's employed maybe at a publicly traded company who does receive the awards that you've referenced, the two most common being restricted stock awards or stock option grants or awards. A lot of times the individual looks at these assets separately because they're not housed in the same location. So I've got a relationship with Scott, and Scott's helping me with my retirement plan and with my investment portfolio. And then I'm getting this completely separate statement from my employer about the awards that I've been receiving. And these things add up pretty quickly, Scott, as I know you've seen in your practical experiences. And before you know it, this individual who's highly successful and really accomplished and valued at their firm, before you know it, a large percentage of their annual compensation, or maybe even a large percentage of their net worth, is now not in a financial portfolio with Scott. It's held at the company through these different equity type awards. And so we generally try to start the process, and I love what you said at the beginning, by really understanding how these pieces fit together. We can certainly talk about all the advanced planning strategies. How do options work? How does restricted stock work? But before we even get there, before we design a strategy, I think it's important to understand what is it we're trying to accomplish.
Yeah.
And so some of the questions that we've outlined here may be helpful in that regard. Before we begin to execute, before we begin to take action, let's talk about a couple of things. What do these assets represent within the context of your total financial picture? Are you planning on using these to fund your retirement or educate your kids? Or are these assets that you might leave behind for the next generation? What's your view on your company stock? How has it performed? And what are your expectations going forward? What about your goal for these assets? What's most important to you? Is it maximizing the value of the awards that you've received? Is it minimizing the taxes because there are tax implications? Is it reducing your concentration risk? These are all the kinds of issues that I think need to be discussed or addressed before we begin to design a strategy. And I think those last three questions at the bottom of my list, Scott, they're my favorite. And here's why. When I was in practice, I worked with a lot of C-suite executives. A lot of them had circumstantially, not intentionally, accumulated a significant allocation to company stock. They kind of ignored it. They kind of kept their fingers crossed and assumed that as long as the stock kept going up, no problem. But we do realize over time, there is a concentration risk. And we do need to be intentional. We need to plan and think about, what is our goal regarding these assets within the context of our overall portfolio. So I love the last three questions, Scott. If you didn't work at your company, right, you've got $10 million portfolio, $9 million of it is in XYZ Corp. If you didn't work there, how much of the stock would you feel comfortable holding? How about the last one? If we were starting from scratch, if I put $10 million of cash in front of you today, and we were designing a portfolio that is consistent with your objectives and your circumstances, how much do you think you would allocate to the company stock? Most often, that's a very different number than what they're currently holding. And maybe that reframing helps the individual begin to think about these things in the right context.
I couldn't agree more. I love those questions. We've spent time on similar versions of that. I think that's so powerful. And I know you've spent a lot of time on the psychology of investing in money and behavioral finance and, the anchoring of a certain price of the stock or that the endowment effect, right, John, where we tend to value something more that we have in our possession. I've got a used car sitting on the driveway that we should probably sell, but I've got a price. I have a lot of memories tied up in this thing. It's great, and I don't know why other people don't understand why it's not worth what I think it's worth. But we get into that with company stock, and there's so much tied in. You're on that team, you're striving for the goal with the company, you're awarded it, and I think it gets very clouded. The emotional ties. Politically, does it look good or not to be diversifying, or how much stock you should hold? And, there's some very mechanical things that make this tricky. I mean, oftentimes there is a requirement to hold a certain amount, right, John?
Yeah, I love your reference there, Scott. So we can talk about all the tactical issues. What's the vesting? What's the bargain element? When are taxes recognized? How do I diversify your hedge? We can get to that later. I love where you started the conversation, which is recognizing some of the emotional biases that are often present. Because after all, Scott, we're favorably disposed to the position because it's made us a lot of money. So what's the problem here, Scott? Why I don't see the problem that you're referring to. I'm so lucky to work at Amazon or at Keysight or at Google, and I've been, or United Healthcare up in your neck of the woods. I've been so lucky. This stock has done really well for me, and so therefore I have a very different psychological view, an emotional view regarding the position. I think you hit on four of those biases that are often present. Overconfidence. We assume that we can predict the future returns of our securities. Reality is we probably can't. Status quo bias, which is my easiest decision, Scott, is not to make a decision. I'll just keep my fingers crossed and let this thing go. Third one is the home country bias, or maybe the familiarity bias. I work in tech. I own a lot of tech stocks, and that may or may not necessarily represent the proper allocation. And then what you referenced, the endowment effect. Because I own it, I generally ascribe a greater value to that position than I would objectively. So those are some of the common biases.
Yeah, it's so powerful. And, we see these in many areas with lots of types of clients. Here in Minnesota, John, we've had quite a few clients that have inherited farmland. I find that's one of the most strong emotional attachments. Sometimes it's a piece of real estate or company stock that, grandpa bought, and said, never sell the railroad stock or whatever it is. But
Yeah.
it gets extra tricky in this situation because there's so much at risk. Your job, your income is tied to this company. A lot of your future is tied to it, and having this pile of stock and things, it gets often you're dealing with a short timeline, maybe a 10-year period to make a decision on certain grants. And it's not just owning the stock, but in some cases, look at the options, that leverage effect, which can be so powerful on the upside, right? All of a sudden you can see dollars just magically appear on a balance sheet, but boy, they can disappear in the blink of an eye. And we know individual company stock risk is much, much greater than diversified portfolio. But then when you add in that leverage component, the short time frame, the psychological sort of pressure to own the company or to not sell, it can be very tricky to find those right decision points.
I think you're right. And that single stock risk that you referred to, Scott, I think is such a basic financial planning concept, right? Every time I diversify, away from a single position, every time I add additional holdings that are non-correlated or not identical, I'm automatically benefiting, right? I'm getting all the returns of the different asset classes that I'm including, but I'm automatically reducing the overall volatility in my portfolio. And at some point in our lives, return is, of course, always an objective, but at some point in our lives, managing volatility, particularly when I get closer to retirement and I now got to draw on these assets, managing volatility becomes critically important to my financial success. Scott, I'm willing to bet you, and once again, this maybe gets back to overconfidence or familiarity. If we were having this conversation 20 years ago, Sears and GE were considered to be blue chip, highly secure companies. I'm not criticizing them. Don't take my input as some sort of condemnation. But, the reality is sometimes bad things happen to a good company or to an investor who holds what they thought was a good financial instrument. Look at Sears, look at GE, and I guess these are only examples to illustrate what you've referenced, that single stock risk and how it can be so damaging to an individual who is highly concentrated in that position.
That concentration in leverage, we've seen it many times, it can be a great wealth builder. It's a high potential position and it can build great wealth. You tend not to see or hear about all the cases where it doesn't work out. You see the examples of the people who did make it big, but it's not a great position for maintaining and preserving wealth over the long haul. And I mean, those two companies, oh, sure, this time of year, you wind it back to when I was a kid, mom would be taking me to Sears to buy a new pair of jeans and some school supplies. And a month or two later, I'd be poring over the catalog, getting ready for Christmas and, hoping Santa would see the pages I dog-eared there and the things I circled in the catalog. And when I was in college as an undergrad business major, we studied Jack Welch and GE extensively. I mean, that was it. That was the pinnacle company. And, great companies, and they can be great companies. They can be market leaders. Very few of them tend to stay that way over a long period. And when you have long-term personal goals, or you're thinking about intergenerational wealth, or, you're thinking about legacy planning, it's very important to consider that. It's, I saw a list. If people are interested, send me an email and I can follow up it. It's the Russell 1000 top 10 companies in the year 2000. And these were the tech high flyers. Only 3 of them have had a positive return over the following 20 years. And
wow.
It's dramatic. I remember seeing a piece about the Forbes 100 top company list in 1917. And I remember I saved this because in 2017, they looked at it and it was less than 20 of the companies were even still in existence. I want to say it was like 17 because it stands out 2017 and 17 companies 100 years later. So it is dramatic. It's hopefully you get that position, you're in that seat, you have the opportunity to really build some wealth and see it appear with that concentration, maybe the leverage and stock option. But one of my favorite sayings, John, the old trader saying is, pigs get fat and hogs get slaughtered, and you want to be a smart, happy pig and consistently scrape away gains at opportune times and not ride it to the last second and see it all vanish.
So that's the challenge for most investors. So let's come to a basic agreement, and I'm going to oversimplify. I work at XYZ company. I'm guessing that the proper allocation to company stock is not 0, right? You would probably allow me or suggest that it's prudent for me to hold some, but the proper number is not 100 either. So congratulations. Right. we've come to a conclusion. It's not 0, it's not 100, it's something between the two. And that's where I need your help. Yeah. I need you to help me understand how much exposure is appropriate, what the implications are within the context of everything else I own and my time horizon and the volatility I'm willing to accept and the cash flow needs I have. I need your help with all the modeling and planning work that you do to come up with, there's not an exact science to this necessarily, but to come up with an appropriate allocation to company stock. It's not 0. I probably want some. I'm lucky I keep getting additional awards from my firm, but it's probably not 100% either. And that's where the great tools that you have at your disposal can help me understand, what does it mean if I have a 25% exposure or a 50% exposure or a 75% exposure? What does that mean regarding the impact on my financial plan during periods of market volatility?
Yeah, I think that's great. You reminded me, frequently you'll see a rule of thumb tossed out. I think some of these rules of thumb are good starting points, but they're rarely the right answer. And oftentimes you hear, you shouldn't have more than 10% of your portfolio or maybe your net worth in one company stock. So I think that's an interesting point to consider, but I really try and take a look at what is the overall net worth and what are your cash flow needs. For one investor, they may have 50 or 75% of their net worth tied up in one stock. But what's very important to know is if that goes away or it goes into a slump for a long period of time, is that remaining 25% in a diversified position that can carry you through, fulfill your life's goals, do everything you want to do? If so, hey, great, you have the budget to carry that extra risk in the concentrated position, maybe look for extra wealth building opportunities, maybe really wait to try and work on ideal tax timing. But if you're not there, if that present value of your future spending needs and goals is not funded, well, then, we're probably going to really encourage you to say, yeah, we want to capture gains and diversify and have less exposure to that specific company.
Yeah, I like what you said. So there is, we can use rules of thumb, and there are so many of them that exist in the investment or financial planning world, but I do think it comes down to personal circumstance. For one individual, if they've got sufficient resources, right, whatever that number is, to cover their needs, well, maybe taking that incremental risk by remaining concentrated is appropriate. For somebody else who doesn't, who needs that capital, who has a shorter term horizon, who has fewer assets that are producing the cash flow needed to fund their liability stream, then maybe that's a completely different answer. So it does become, and I apologize for the ambiguity of the statement, it does become very much a personal issue. We're talking about equity awards, Scott, right. And here are the two common ones. Maybe, this is helpful in framing the conversation for some of our friends. The two most common equity awards that we see companies issue to their employees are restricted stock, either shares or RSUs, very similar, or employee stock options, both NSOs and ISOs. And so I thought I'd spend a minute just kind of defining the basic characteristics and
please,
we continue the conversation. So both of them are subject to vesting. What does that mean? And so Scott's an employee at my firm, and he gets a letter in the mail and says, congratulations, Scott, you're a valued employee. We want to retain you. We want to motivate you. We want to link your personal success to the success of the company. We're going to award you either restricted shares or employee stock options, but they're not immediately yours, Scott. You got to wait for a period of time. That's the linkage that the company likes. It kind of requires you to stick around and to work hard and to help us build value in this company so that you'll ultimately benefit from it as well. That's called the vesting schedule. That vesting schedule comes in two flavors, either a single date, 3 years down the road, hypothetically, or a graduated vesting schedule where a percentage of the award, 25% per year, might vest over the next 4 years. Options provide leverage, Scott. So when I get that option award, there's no intrinsic value. The stock's at $20 today. That option award allows me to buy the stock at 20. And so my economic gain comes from any increase in stock. If the stock goes from 20 to 50, well, I've made a $30 gain based on that fixed strike price from the option award. Restricted shares work differently. Restricted shares say you get the entire value of that stock when the vesting occurs. So if the stock goes up, great. But if the stock stays flat or goes down marginally, there's still some intrinsic value in a restricted stock award. The key thing that our friends need to be conscious of, and obviously you're great at this and you can guide them and educate them through it, is the triggering event, which essentially recognizes when taxes will be paid. With a restricted stock award, it happens automatically. Nothing I do. It just happens automatically at the vesting schedule. And it's taxed as compensation income, 37% plus 0.9 if I'm above 250, plus FICA taxes too, by the way. It's viewed by the IRS just like, cash compensation would be. It's another form of comp. The option gives the employee a little bit more control. Taxes don't occur when the award is made. Taxes don't occur or are not recognized when the shares vest. Taxes are recognized when the client decides to convert or exercise the option into physical shares, whether they sell the stock, hold the stock, or give the stock away. So those are the two primary differences between your options and your restricted stock.
That's great, John. You had some questions earlier, important questions to consider, to ask. And in regards to the restricted stock, your question there, if you had money in the checkbook, how much of this company's stock would you buy? Let's open it up and buy another $100,000 worth. And most people say, I don't think I want to do that. I have plenty of exposure, because I work there and I'm getting grants. But it's because of the form of compensation, because it's a stock. I find oftentimes people get kind of stuck in there and they think there's some special benefit once that automatic vesting date has hit with the restricted stock. Excuse me. And there really isn't. I mean, the way I try and encourage people to think about it is exactly like a cash bonus at that point. Would you turn around and write a check to buy that stock? That is the decision.
That's exactly what the client is doing. But when that when that stock position vests, they're paying taxes. So congratulations, you've already paid the taxes. And now you're holding the stock. And I love your framing. The idea being that, wait a minute, if you got the award in cash instead, would you turn around and buy that same quantity of stock? And maybe that framing helps the individual think about that decision a little bit more clearly.
Yeah, and maybe you would. Maybe you love the company. You're very excited about the future. You're comfortable with the risk. Maybe they pay a great dividend. Maybe you have a stock retention requirement. There could be a number of reasons why you do want to maintain those shares. But at that point, your basis is the fair market value at the point of that vesting. The taxes are due. There's no leverage going forward. It is exactly the same as if you were handed a cash bonus and you turn around and bought the stock. So that's why I really try and encourage people to think about the restricted stock that way.
Yeah, let's take a look at the restricted stock. You brought it up. So let's kind of clarify some of those dates and consequences that you've just referenced. Maybe this example will help. So Scott gets an award on March 1 of 2016, the stock's trading at $20. Hey, congratulations, Scott. You've received the award. It's not yours yet. You got to wait until the vesting occurs, but this is our indication to you, our appreciation to you, showing you that you're a valued employee. We want to reward you. We want to retain you. We want to motivate you. We want to make sure that you personally benefit from the success that the company hopefully enjoys. Okay, March 1 of 2019, in my hypothetical example, 3 years later, these shares vest. Scott, you didn't do anything. You simply stayed at the company, and good news is the stock went up and it went from 20 to 50. Now you own the asset. And to your point, that full $50 value is taxed, just like it would have been had you received a cash bonus. Your cost basis is 50. So this idea of, well, maybe I should just continue to hold it to reduce the taxes. No, it doesn't work that way. You're paying the taxes based on the value of the award that you've now received. And you've got a decision to make. Should I continue to hold it for whatever my reasons might be, the dividend or the optics or my belief that it's going to continue to go up? Or since I've already paid the taxes, maybe I sell it and I use those resources to diversify into other asset classes. In my example, just to make or illustrate the point, in this example, Scott, you got the stock at 20, it went to 50, it vested, you paid the taxes, you held on, you didn't sell it. And then you eventually sold it a year later. Then any additional gain or loss would, increase or decrease, would produce a gain or loss, either short-term or long-term. It established a new cost basis at the time of vesting. And so you've got the decision to make as to whether or not you should hold it or consider other alternatives.
Yep. John, we've had a few cases where the executives are actually being given the option to choose their mix between restricted stock and stock options. Is that more of a trend nationally, are you seeing, or? Are those a
Yeah,
few
let's take a look. I think
pages?
I've got some data there. Give me one sec. I'll try to find it. Maybe not in this deck. Yeah, here we go. Let me see if you can see it. Hold on one second, buddy.
Ah, there we go.
Can you see it?
Yes. Yep.
Okay, fantastic. For some reason, I lost the imaging. Okay, here we go. So options were very popular back about a decade or two ago. A lot of companies, think about high-tech companies, Scott, out on the West Coast. They didn't have a lot of cash. They were burning through the funding. Right. They were hiring people trying to grow the business. And so what they didn't want to do is use that available cash to hire and pay employees. What they did instead is they offered a promise. Come join us, be part of this team, this hopefully successful company, and we're going to award you with options instead. And so that was a popular trend back in the 90s and early 2000s until the tech wreck occurred. And then all these individuals who signed on, not necessarily for cash comp, but for option awards, they saw the great leverage. We read about, overnight millionaires who were lucky enough to have received option awards in Amazon or Google or Facebook or whatever, United Healthcare. Yep. Well, Scott, I will tell you this as a personal aside, my largest equity position in my entire portfolio is United Healthcare. What a great, I was so lucky.
Congratulations.
Yeah. I promise you, it has nothing to do with me. I just had followed the HMO industry when I was an advisor. I'd owned HMO of America. I had owned, what was the one that got bought out by CBS? A couple of HMOs, a lot of consolidation in the industry. What a great company United Healthcare has been. I think my cost basis is $25. Wow. The stock is 550 today. So hypothetically, the client receives an option award in United Healthcare. That's a good story. Yeah. And it, of course, creates significant value. But we've got plenty of examples of companies that didn't perform as well as UNH did. Those high-tech companies that all crashed back in 2000. And these option awards that the employee was viewing as a significant asset in their lives, it all went to zero. And that's why companies today are tilting the scale a little bit more toward restricted stock. There's less leverage, less upside leverage, but there's more intrinsic value, retainable value that will provide a benefit to the company and ultimately a benefit to the employee as well. You can see the mix of that compensation on the slide.
For sure. It seems like we are definitely seeing that trend. The previous slide you had up, John, maybe we should roll in there. You gave a nice explanation of restricted stock, and oftentimes people are paired with getting stock option grants, or maybe they have a choice for that mix. Sorry to throw you for a loop there, but you had kind of a nice breakdown with the options and grants. What do we need to know about options?
Yeah, let's talk about options. So we went through the example of a restricted stock award, right? The grant date, the vesting date, and then the ultimate sale date. Let's do a similar comparative to, once again, better illustrate how the option works. A little bit different, right? So let's go through those mechanics. And so Scott, once again, works at a great company, XYZ. He receives an option award, non-qualified option award, with the stock at $20 a share. And that's a fixed strike price. That's a promise that Scott owns this promissory note that he can buy the stock at a fixed price of $20 a share. Okay, vesting occurs. Once again, Scott can't do anything with it immediately. He's got to stick around. That's why we gave it to him. We want him to stay. We don't want him to jump to a competitor. We want him to work hard. We want him to build value in the company so that he benefits financially as well. Scott does that. And sure enough, 3 years later, on March 1 of 2019, when these options vest, good news, Scott, the stock's gone from 20 to 50. So there's a $30 gain. Remember, the value of your asset here, it's not $50 to you. You're not getting shares. You hold an option which provides you the opportunity to buy it at 20. The stock is currently trading for 50. So you can probably tell that your economic gain or benefit is the $30 differential between the two. But unlike the restricted stock award, where it became taxable when it vested, that doesn't happen here. You haven't monetized yet. It's only in 2020, the third bar. On March 1 of 2020, Scott, good news, the stock went from 20 to 70. Scott goes ahead and he exercises. He takes this promissory award that he's received and he uses it to buy the stock at 20, and the stock is currently trading at 70. Scott now has a gain. of $50 a share. And that's when Scott's going to pay his taxes. That's going to be ordinary income, 37%, plus your 0.9, plus your 6 and change, FICA taxes as well. In this example, Scott can go ahead and sell the shares immediately. That's called exercise and sell. Or Scott, after exercising and paying his taxes, may decide for a variety of reasons to continue to hold the exercised shares. And then, of course, he's established a new cost basis, which would produce either a gain or loss when the underlying stock is eventually sold in 2021. I hope that's helpful.
That's a great breakdown, and I like the visual here. It's helpful. One of the big differences that you touched on is that leverage component. You have the potential to benefit from the full appreciation of the stock, but you don't have all of your value in there. You're just paying that exercise price. And sometimes I find a comparison. A lot of folks are familiar with how that works with real estate. You put 20% down on a property, and the property goes up by 20%. You've had like 100% gain, not a 20% gain. So it's similar in options. And maybe for our next time we talk a little bit more advanced, but then it gets fun. In each option grant does not have that same leverage impact, right, John? There's a difference between the amount of time left in the options, and there's a difference between that spread in the exercise price and the market price of the stock. And that's something we spend quite a bit of time on thinking about, is not just should you sell, but then looking at the specific grants that an executive may accumulate over the years and piecing that together, looking at what is the value at risk, what's the potential forward-looking leverage, and higher priced grants tend to have more future leverage. So looks like you have a slide here, but I'm wondering, Black-Scholes option pricing formula is kind of the academic approach on this. There's tools like Stock Opter that come up with their insight ratio. Do you have any favorite ways of looking at that type of thing?
Yeah, let me pull one up here. Let me stop this particular deck and let me bring up another one that may be helpful in that regard. Give me 1 second here.
Sure.
Executive comp planning strategies. Here we go. And so, as you probably know from our earlier conversations, Scott, I am a big LA Chargers fan. And so I've got a hypothetical with one of the Chargers used in the specific example. Let me see if I can find it here. Give me a sec.
Sure.
Because I think you bring up a good point. We're looking at, just really the fundamentals of an option award and how it works. But I think what adds additional complexity to the equation, Scott, which is what you've referenced, is the idea that it's not just one award, but I receive awards, multiple awards over various periods of time. And so in that circumstance, the question that you're probably asking is, how do I think about these various awards within the, it's not just a singular award. How do I think about all of these? Because I'm getting one when I first start, and then every year, if I've been a good employee and the company's doing well, I'm receiving additional awards. That's what adds some complexity to the decision-making process. So here's our friend Keenan Allen, and he's received a bunch of stock option awards, and you can see the different dates. He got an award in 2016, and he got another award in 2017, and he got another award in 2018. And by the way, these awards, because they occurred in different years, they come with different strike prices, some a little bit higher, some a little bit lower. Well, the stock's gone up, but certain awards have more intrinsic value than others. And by the way, since these awards were made at different points in time, they have different expiration dates, different longevities that are associated with them. And that's where the planning process becomes a little bit more complicated and a little bit more useful. If Keenan needs money to build a new house in Naples, Florida, he's very envious of me. He wants to come down and play golf with me and play pickleball with me and go running on the beach with me later on this afternoon. He wants to come to Naples, Florida, and it's going to cost him a couple of $1 million to do so. The question that he's probably asking is, okay, I've got these different awards, all with different ramifications or characteristics. How do I think about, Scott, which ones I take off the table? Mm-hmm. Which ones should I leave behind? Which ones should be exercised? In what order might I think about doing that? Right. And so that's really where the complexity begins to
Yeah. That's where it goes from playing tic-tac-toe to trying to solve a Rubik's Cube, as I like to say.
Right. It's a good analogy.
Yeah. I mean, so, and this is something I just, maybe to reiterate, since you have some numbers up here, because I find this is something we do spend quite a bit of time with people in the beginning. And so here you show 3 years worth of grants, but hey, we're in 2022, you know, they may have 2019, 2020, 2021, 2022, and that's what happens. And you have a hypothetical stock value here of $60 per share. Let's say good things have happened and it goes from 60 to 70, you know, and we say, hey, let's take some gains off the table here and let's use that to capture some of this concentrated leverage position and move it to what we hope is a higher probability diversified position, and gain some confidence in funding some of these future goals, or, you know, just capture some spending money to go buy that boat or whatever. But if that stock moves from $60 to $70 per share, the effect on your balance sheet is not the same for each of those grants, right? So, I mean, the $55 exercise price grant that I see there listed in 2016, that will put more dollars on your balance sheet than the $35 share with the lower strike price. However, you have one less year left on the $16 or the 2016 grant. So it does get interesting. Yeah.
It does. I love the way that you thought about that decision making, right? So let's assume that the client needs a certain amount of capital, right? So there are a couple of ways to look at it, which is I want to reduce my downside risk if the stock were to fall, or I want to retain more for upside participation if the stock were to rise. Or let's look at it a third way, Scott. Keenan comes to you as his financial advisor and says, look, I need $50,000 as a down payment for this condo that I'm buying. Which one of my option positions does it make sense for me to liquidate? Well, I would look at this and say, wait a minute. Okay, I've got 3 different options, and I do understand that they have different expiration dates. That might be one input in the decision-making process. But the way that I would look at it is, wait a minute, Keenan, the 2017 option position has the greatest bargain element. What does that mean? You have to exercise and then eliminate, take off the balance sheet, a fewer number of options. So if Keenan's goal is to come up with the cash that he needs, but also to retain as much future exposure for additional gain, I might go to the 2017 option and say, Keenan, let's go ahead and exercise and sell those shares, because I can get you your $50,000 by liquidating or eliminating the least amount of option exposure, assuming that, once again, Keenan needs a specific dollar amount, assuming that Keenan wants maximum exposure for future upside appreciation potential. That's
great. That's great. Yeah. How to efficiently capture gain and still leave plenty of upside.
Yep.
But there's 2 different flavors of options, right, John?
Yeah, let's get into that. Let's talk a little bit about the second type of option. So we talked about the restricted stock first, and then we covered the very popular 95% of option awards. We covered the very popular non-qualified stock option, but it's important to note that there is a second flavor of an option award. And I'm going to try to pull it up right here. Give me 1 second. Oh, it's not here. Let me find another deck.
Maybe while you're looking for that,
I got
it. If you're moving from one company to another, you're being recruited. I mean, you're thinking about the role, the title, your responsibilities, growth in your position. Do you like the mission of the company? All those qualitative type factors, very, very important. But, evaluating the package, give us a call, because, it's easy to compare salary, maybe salary and bonus, but there can be a tremendous difference, right, John, in terms of what's laid out in the mechanics of an equity compensation package.
You got to read the plan agreement. You got to roll up your sleeves and do the work, whether you're doing it yourself as the employee or you're doing it with the great help of a financial advisor like Scott. There are a lot of nuances and there are a lot of differences. Every plan works differently. I wish there was some uniformity. There isn't. Every plan has different characteristics. The plan administrators send information that looks very different. That spreadsheet that I showed you regarding Keenan's position, that's often step 1 in the process. Just help me understand, Scott, what do I own?
Right.
I don't understand. I understand the brokerage statements that you're sending me. I do not understand the option or restricted share. They're using all this funny language in there that I've not seen before. I don't really understand what I own and how it works. And so sometimes in this planning process, in addition to the front end issues that we discussed regarding objectives, the second step in the process is just help me organize and understand what's there, so that now that I have a better understanding of what's there, I can make informed decisions as to how I want to treat it or manage it. So we started first with restricted stock. We then took a look or talked about non-qualified stock options. They're the most common. And as you may remember, we identified the issue that once they are exercised, once the client captures that increase in value, it's reportable as ordinary income. Ordinary income rates we know max at 37%. There is an option position, if you're lucky enough to get it, that comes with a unique tax advantage. It's called the incentive stock option. Now, these are not granted as commonly, but it's important to understand how they work. The incentive stock option is not taxable like the NSO was when I exercise. The incentive stock option comes with a unique tax advantage. If I meet what's called a qualifying disposition by holding the position a minimum of 2 years from the date of the original award and an additional 1 year after the exercise, if I meet those required holding periods, then when I sell the stock acquired through the option position, not taxed at ordinary income, Scott, it's taxed at long-term capital gains. And I think all of us on the line recognize that huge benefit between 37% ordinary income and 20% long-term capital gain treatment. Let's illustrate with this example. So this is Scott again. And in this second example, Scott's holding not an NSO, but an ISO with that unique tax advantage that I just articulated. So Scott gets the award on March 1 of 2016. And just like before, it's not his yet. He hasn't done anything with it. He hasn't monetized. No taxes are due. Scott's going to stick around. He's going to keep his fingers crossed. Scott's going to hope that the stock goes up in value so he eventually gets rewarded for it. The option vests on March 1 of 2019. Scott now has the ability, if he wants to exercise the position, but he doesn't yet. He's hoping or thinking that the stock's going to continue to go up. And now, sure enough, in 2020, Scott goes ahead and he exercises. Once again, his exercise price is fixed at 20. The stock is currently trading at 70. So congratulations, Scott. You've got a gain there of $50 a share.
I like it.
But unlike the earlier example, where Scott recognized ordinary income when he exercised his non-qualified option, it does not work that way with the ISO. Scott does not report any ordinary income because, once again, it's not taxed when it's exercised with an ISO. It's taxed when Scott eventually sells the underlying stock acquired. And in this example, you can see that Scott sells the stock on March 2nd of 2021. Scott met the qualifying holding period that I referenced a moment ago. He held the stock a minimum of 2 years from the original award and a minimum of 1 year from the exercise of that award. And so in this example, Scott does not pay ordinary income tax in 2020. Scott pays long-term capital gains on the entire profit in the year 2021.
That's great. Thanks for the overview and the illustration.
I'm sorry. It's like I teach class, and I'm digging into this thing, but I don't know. I think we got to know how this stuff works.
It's fantastic. So John, not many people have the opportunity to participate in the ISOs, the incentive stock options, but there is something that's a little bit related maybe in terms of a technique that maybe you could tell us a bit about this Section 83B election. You might hear that tossed out. The ability to say, okay, I don't have ISOs. That's a different tool that just isn't used very much, but there's an option some people consider to say, is there a way to turn future appreciation into capital gains sooner? Can you tell us a bit about that?
Yeah, absolutely. So I love the way that you did that comparative, Scott. I think that's very helpful in terms of understanding how this thing works. So the ISO, which we just articulated, came with the unique tax advantage, and that was converting ordinary income to long-term capital gain rate. And the question that you're asking is there another way to do that with either restricted stock or option awards? And the answer is yes, if the plan permits for it. It's called the 83B election. the 83B election must be made by the receiving employee within 30 days of the grant. So number one, it's got to be in the plan. Some plans offer it, some don't. If it's in the plan, once you receive your initial award, you got to make this election within 30 days. How does it work? It says that instead of waiting until vesting, when I then go ahead and pay my taxes, when the shares or the option position is controlled by me, I'm going to go ahead and I'm going to recognize the income today within 30 days, hopefully recognizing ordinary income tax and a lesser amount today, so that if it grows like it did in my example, when the position eventually vests, either the restricted stock or the option award, and I now liquidate at that future point in time, that additional gain that accrued over those 3 years will be taxed at long-term capital gain rates. That's the upside of the 83B election. And it's pretty obvious. I'm making the election within 30 days. I'm starting the capital gain clock ticking. When the position eventually vests, I now have the opportunity to liquidate and to do so at long-term capital gains, not ordinary. What's the downside? Why wouldn't anybody do it if they have the opportunity to do so? The downside is you've gone ahead and you've exercised or you've paid the taxes within that 30-day window. You've now got your own skin in the game, Scott, but the option or the restricted stock is not yours yet. You've got to wait until it vests before you can do anything with it. And so what could very well happen, in fact, what did often happen back in 2020 during the tech wreck at the turn of the century, people used the 83B election for the obvious tax advantages only to find that their stocks crashed. And so they recognized a very significant financial loss seeking a particular tax advantage.
Yeah, there's always a hitch, isn't there?
Usually there is.
that past performance is not guaranteed, is it? Yeah, that's great. Very helpful. And it is certainly worth considering. But I do think there's considerable risk there. You know, you're voluntarily prepaying these taxes on stock you don't own. And if it goes up, and if it goes up a lot, great. It's probably a big win for you, but it doesn't always work out that way. You know, maybe just as a quick aside, it kind of reminds me of something else we're often taking a look at, John. I mean, tax planning is so huge around this, right? We see the tax bill for a lot of our C-suite type clients, or super highly compensated sales professionals. You know, taxes are often the biggest item on their budget. But so sometimes we're looking at delaying a year for exercise, or holding for that capital gains treatment on the incentive stock options, or considering an 83B election. Think about those tax strategies. But I always like to do the math and just say, what would happen if that company stock went down by 10%? Because it's very interesting. Oftentimes, especially the options, relatively small movement in the stock price will cause you to lose more value than less efficient tax strategies. So we try not to have people get too anchored on always optimizing for taxes, when the reality is those dollars could be wiped out, and it could look like, you won on the tax standpoint, but you lost in terms of the overall wealth capture.
It's a good example, Scott. It refers back to what you had identified a little bit earlier. Mm-hmm. It's the leverage of an option, that the incremental gain or loss has a magnified impact on my return. Yep. With restricted stock, if the thing's at $50 and it goes up or down by $10, it has an impact, but not a significant one relative to the value of the total award. With an option position, that $10 gain or that $10 loss has a magnified impact on the net profit I'm able to receive or extract from the option award position.
Well, very good. So much we could talk about here. I see you've got the deferred compensation slide pulled up, and that would be great if we spend a few minutes on that, because
maybe that's what we cover as our last item today. I know we're going to do some more advanced to have a discussion about advanced planning strategies during our next call. But let's cover the basics around another equity benefit similar to the options or restricted stock. It's non-qualified deferred comp, otherwise known as 409A plans. We all know that contributing to our retirement accounts, like a 401k, or if we run our own business, there's additional retirement account opportunities to contribute money for future retirement, lowers our current tax bill, allows us to grow money on a tax deferred basis for future retirement purposes. Well, what about the highly compensated individual? That individual making, just to make up a number, $1 million a year, $19,000 a year into a 401k, or maybe the number's 20,000 this year, I think. It's nice, but it's not meaningful regarding that individual and their financial circumstances. And so 409A plans, they're non-qualified, meaning they're not governed by ERISA, and therefore they're not subject to those same compensation limitations that traditional or qualified retirement accounts are. What does that mean? That means the individual, if the company happens to provide this option, has the ability to set aside more of their annual compensation to save tax dollars today and to accumulate dollars for future retirement benefit. These are non-qualified. You are general creditor of the issuing company, and that means that you're taking risk. If the company goes bankrupt, it's a liability, and they may or may not pay you. And so make sure that you understand that. But what happens is, instead of receiving the compensation and paying ordinary income taxes and state income taxes today, I don't receive the compensation. It is deferred into a 401k type menu where I get to pick different investment options, but I'm not realizing $1 million of income, paying $400,000 of taxes, and having 600 grand net to reinvest. I'm getting the full compounding on the full $1 million. No taxes are being withdrawn. I then compound that money for a certain prescribed period of time. And then eventually, based on a triggering event, separation from service or retirement or a couple of other examples, I then take distributions over a specified period of time. Now, those distributions, when they come out, they're taxed at ordinary income rates. And so there's some math involved to essentially decide, am I better off receiving the compensation today, paying the taxes, and having a lesser dollar amount to invest in the way that I want to now, or am I instead better off not receiving the income, having the full value of my bonus check set aside in a deferred comp plan, getting compounding on a larger dollar value, but then eventually distributing it subject to ordinary income rates? So there is some modeling. What is the rate of return? What is the expected time horizon? What is your bracket today, and what do you think it's going to be like in the future? Are you still living in up in Minneapolis, subject to a 9 or 10% tax rate, or are you down in Florida or Texas, subject to a state tax rate of 0? There are a number of variables that need to be baked into the equation to determine whether or not it's suitable.
Tremendous wealth building tools potentially, but yeah, you want to understand the complexities. Like I say, we usually start, we're going to be having these conversations in the next month or so with folks, having to make their election for what they're going to defer in 2023, but we have to decide now how much they're going to put away. We don't get to change it, and have to choose how you want those dollars paid out, at separation from service immediately, or over 5 years, over 10 years. So there is some, substantial risk of forfeiture, I think is the formal term, right? And there's some liquidity constraints, but it is the potential to really pack away some dollars on a tax favored basis. And marrying these concepts and these tools up is just one of my favorite strategies, where you look at someone who's done well. You mentioned United Health. Happily, we're working with a VP who's in the process of retiring right now. And the last couple of years, we've looked at those fantastic gains in the company position and matched those up with deferred compensation contributions, at least tried to. And so take a look at it and say, here have been great gains from concentrated, highly leveraged positions that have done very well. Take those, it's going to create a tax implication, but immediately offset that, kind of moving it from one pocket to the other with the deferred compensation plan, where it gets to go into a diversified portfolio. So,
yeah. I love the idea of matching things together, Scott. Let me bring up one other point. So this conversation about these equity awards and all the tax recognition that we've described in our earlier examples, great way to think about maybe marrying those awards and the strategies associated with it and the resulting tax consequences, maybe with tax beneficial planning like charitable giving.
Yeah.
So maybe I've got a restricted stock award and it's vesting this year, and I got a big associated tax bill. And that I've been very charitable towards my church. And so you come to me, Scott, and say, wait a minute, John, I know that you've got this significant equity award that's going to produce a big tax bill for you this year. Let's go ahead and take a little bit, let's take an intentional look at the charitable giving that you're doing. Let's figure out how much you plan on giving and when you give and who you want to give to. And maybe we can marry those two things together to fulfill your charitable intent, but to also solve for the tax implications from the equity awards you've received. This is that comprehensive, holistic planning that I know your firm is so damn good at.
Yeah, that's fantastic. We that's always a fun one, seeing someone who's done so well on the job and had great success there, and then finding the most efficient way to use those fortunes to to fund what they're passionate about through the charitable giving, and there's some excellent benefits there with the tax deduction, the income tax deduction, the ability to move those dollars over and diversify inside that tax sheltered environment in the form of like a charitable trust. So great opportunities. Well, John, this has just really been great. I can't thank you enough. Appreciate the time. John's written a lot about this, and if you Google him, you'll find other interviews. And we have time, but we're going to come back again and talk about some more advanced exercise strategies. On my blog, I've posted quite a bit on these types of topics, which I don't know if I ever shared this with you, John, but I named my blog Intrinsic Value. So I do write quite a bit about these specific type topics. So we'll be sending out a notice, and happy to answer any follow-up type questions. People can send me an email or give me a call, but appreciate you all coming and looking forward to our next session, John.
Thanks a lot, Scott.
Take care.